Craig, you can go ahead and get started anytime.
Awesome. Thank you. Well, good morning, and I guess good afternoon to some as well. Welcome to the presentation on 6 alternatives to rewarding long-term performance without sharing stock. I'm Craig Rutledge, Senior Vice President at VisionLink, and I'm going to walk you through our presentation here today. This is a top-of-mind topic today, I think, in today's marketplace with privately held companies. I'm sure many of you out there, as you see our initial framing of today's topic here, have probably had this conversation before with some of your top leaders, which is, can I have equity? And it's a complex question with some great alternatives and answers we're going to give you here today. Here is a majority of our clients have this mindset as they answer this question, which is, I really need this person, and I am possibly willing to share stock if we can create a bigger pie, if we can grow the business. But what happens if that doesn't happen? And how much stock's going to satisfy this person? What's it going to do to my value? Am I opening up a Pandora's box to others? Am I going to have others following this one here? How do we trigger liquidation? What is it going to cost me to share this equity? So some questions that have to be answered, but it does matter. As I mentioned at the start there, this is an extremely top of mind issue for high performers out there, for companies that want to grow. And it matters because your employees control the kind of experience that your customers have with your company. They're your face. Your employees are your best source for attracting other new talent to your company. It'll help determine whether your businesses thrive or stall, we believe. And the reason for that is that you're really choosing here whether you want these employees to be growth partners with you or potentially even growth inhibitors, right? And so you'll hear us use the term growth partners in trying to really frame a compensation offering that does turn them into growth partners, makes them feel like partners in the business and in the success of the business. And so why, right? Any shareholder is rightfully going to ask, why would I, what are the purposes and why would I install incentive compensation? I think it drives and helps you build a complete pay offering. So it's going to enable you to attract that top talent that's out in the marketplace today. It's going to help secure the retention of those key performers. This is our tagline, if you will, at VisionLink, in creating a unified financial vision for growing your business. And so incentive comp helps you kind of reflect that growth partnership with them. It creates alignment around the same financial targets that you as the shareholder or you as the CEO are trying to drive. It emphasizes their role and the role they play in potentially driving some of these financial targets. It clarifies that for them. It makes the current and long-term priorities clear, and then it rewards value creation. You're able to define that in these different planning options that you have here, is to be able to define that value creation and then reward the people who are creating that. It's going to help really create what we call an ownership mindset. It's going to allow these folks to think and act like you. And the more people you can have that think and act like business owners, the greater chance you're going to have for success. So what are the 6 alternatives to sharing stock that we're referencing here? And I think I would also start and say, hey, there is absolutely nothing wrong with sharing stock either. It's always probably the beginning part of every conversation like this is, should I share stock or not? And what we're going to try to cover here for you today is, if you're leery and maybe it's not what you want to do, we're really trying to show you what alternatives you have out there to create a very similar alignment that you can create by sharing stock. And so we're going to talk about these 6 alternatives. The first is phantom stock. The second is performance phantom stock, and the third is phantom stock options. So as you can see, it falls into a similar category of equity. It's just phantom, and I'll talk about that, how it works, what it does, what it really is. The bottom 3 here, 4, 5, and 6, a profit pool, a performance unit plan, or strategic deferred compensation are also long-term value sharing opportunities, but they just differ in the fact that the company isn't the metric of those plans. There's usually some other financial targets there, but you would kind of differentiate, excuse me, these 6 into the top 3, which are we're really trying to mimic equity. In the bottom 3, we're really using some financial targets in here. So number 1, phantom stock. So I don't want to share stock, but I do want to reward contributions to past and future business growth. And that's what phantom stock does. I'm going to define a little bit more about it so you can get an understanding of how it works. But one of the keys to what we're talking about here is phantom stock is that, broadly speaking, it's a long-term incentive plan. Okay. And so even though we have the term phantom stock and you hear stock, it is really just a compensation plan and doesn't have anything to do with your cap table. It doesn't dilute any of your equity. It will effectively dilute your value via a liability on your balance sheet, but it doesn't dilute your actual equity. And so it is a compensation plan. These are contractual, so they are a contractual promise to pay out in the future. So they differ from your bonus plan, which is discretionary. They're really used to award employees for contributing to the growth without sharing equity. It's kind of a type of deferred comp plan where values are tied to the appreciation of the value of the business or just to the value of the business itself. And so who uses these plans? So we've built 400 or 500 of these plans over the last 25 years, almost exclusively with privately held companies. Occasionally, a public company might use phantom stock, but very rare, and only perhaps if they're out of their equity pool, their employee equity pool. I often say this when get asked the question, who are our ideal customers, or who comes to look for a phantom stock plan? It's companies that are growing. High growth ambition companies are adopting phantom stock. Any business that's competing for top talent against large companies or public companies where they're going to be offered equity are looking for phantom stock. Businesses that want to incentivize growth without diluting equity. So in constructing a phantom stock offering, one of the first things we have to do is establish a phantom share value for the business. One of the distinct advantages of phantom equity over actual equity is the IRS and the regulations in the code don't require that we use fair market value approach, meaning you don't have to get an expensive valuation done to value your businesses for purposes your phantom plan. You can, and that can be used. You can use almost anything you want. Most common would be using a formula. Most businesses out there valued as a multiple of earnings or something along those lines, but we often just use a financial formula to establish the value of the company for purposes of the plan. You put a number of phantom shares into the plan, just a gross number. It's usually just a big round number like 1 million or something like that. It's really just a denominator under your value here. And now we have what I call the currency in these plans, right? We have shares or units or however you want to describe them able to give to employees. And so a share of phantom stock here is equivalent to the value of the stock. So if I give you 1 share and it's worth $10 with a share of phantom stock, you get that $10 plus whatever happens to it out in the future, up or down. There are no rights of ownership that go with this. It can reward for past contributions for people. So to the extent you may have had somebody that's helped you get to where you are today and you want to reward them for some of that past performance, phantom stock's a great way to do that because they're getting to participate in the existing value of the business plus any future growth. But when it's time for payments, a majority of the time, the payments, when you redeem phantom stock from somebody, they're made in cash usually. However, they can be made in stock. And so you don't have to determine that at the beginning when you give them shares. You can determine it at the time. It's mostly settled in cash. But if you get to the point out there where you want somebody to become an equity holder with you, you can actually settle phantom stock in actual equity. So these full value awards is another term we use for the phantom stock here. They can create a great direct link to ownership, right? So when we want to grow enterprise or equity value of our business, this is a great way to link that together with existing shareholders. So what if I don't want to share stock again here? So now we're talking about performance phantom stock, and I want my people to achieve performance standards before receiving these shares. And that's what we call performance phantom stock. So it's really the same chassis, if you will, of phantom stock. But the performance now rides, there's really two levels of performance. The first is I have to earn the shares. So we usually set some goals in earning those shares. So you're given a promise to a participant to receive phantom shares upon the fulfillment of some predetermined financial goals. So typically on an annual basis, you set up some goals. They hit those, you can now award them some shares. Those shares can either be full value, like I described in the first type, phantom stock full value, or they can be appreciation only shares. So either one, I'm going to talk about appreciation here as the third option in just a second. What you create with performance phantom stock is kind of a double pay for performance concept. So shares are earned based on performance, usually short-term performance. And then there's the performance of the actual phantom shares themselves, go up, hopefully up, but potentially up or down based on the performance or the value of the company. So this is just another way of awarding phantom stock shares for people, often used, probably a little bit more common in full value shares. Since a person's earning it, there could be value there. When you award an appreciation share, which you're going to see here in a minute, doesn't have any initial value. So performance phantom stock often associated with full value shares. And we get to the third here, phantom stock options. So again, I don't want to share actual stock and use actual stock options, but I want to provide a benefit that is tied solely to the increase in business growth, like a stock option plan, without having to exercise and buy the stock. So this is a prospective growth and value business. This is used in a lot of cases here where we're saying, hey guys, we have some great growth goals here, and if we achieve them, I want you to participate in those, but I don't want to share any existing value in the business. So this can also commonly be used for new hires in existing businesses where value may have already been established and you want to share value going forward. And so again, type of phantom stock, it's really the equivalent of a SAR, a stock appreciation right, where somebody's just entitled to the appreciation in value from the time of an award. So again, promise to receive a cash payment at a future date. The value is based on the appreciation in the stock price from the date of the award to the date of the redemption. So as I kind of used as an example before, if when you receive one of these appreciation phantom stock options and the share price is $10, and at some later date when it's being redeemed, it's worth $25, you'd be entitled to that $15 of appreciation in there. So it is like a stock option, but there's no need to pay for shares. So you don't actually exercise a phantom stock option and receive the stock. You just receive the difference like a SAR at the time of payment. And so this is directly rewarding the participant for contributing to the increase in enterprise value. It can often be part of an employee's annual pay package. In fact, all three types of phantom stock can be part of the annual pay package, and it's often encouraged because you can award new shares each year if you're using appreciation shares, and you set a new bar each year potentially as you're growing. So as opposed to just awarding them all up front to somebody at potentially maybe a low price and then build up a lot of value, here you stagger that over a period of time with new strike prices, if you will, along the way. You also can attach vesting along the way. So we're continuing to push vesting out so people have a retention component to these in an ongoing basis there. So I would say when you're thinking of these as the alternatives, if I want a true alternative to stock in my company, if I want something that looks and feels like equity, but without the complexities that you might have with equity, without some of the tax implications that you might have with equity, phantom stock's a great alternative. So didn't talk a ton about taxes here. Taxes are pretty simple because it's a compensation plan. There's no taxes to the participant along the way. So when you award phantom stock, even if it has value, there's no tax due for a participant. Even as it grows in value, there's no taxes due. When they receive payment for the value of their phantom stock is when they would recognize it as just ordinary income. So kind of the equivalent of a bonus payment when the time comes. And that's when the company would recognize a deduction for compensation at the time it was paid. So you don't get to expense it for compensation purposes along the way, not until you actually make the payment of the phantom stock to participants. One of the other advantages is tying phantom stock to a potential exit of your business. So if you're saying out there, hey, we might be striving to get a good exit, we can use a formula valuation along the way, like we talked about here. So we could value the business based on a conservative multiple of EBITDA as an example. But then when we actually sell the business, we can convert the valuation of the phantom stock to the actual sale proceeds of the business. So you might be valuing phantom stock if you're paying people before a transaction conservatively, because you don't know what's going to happen in a transaction, but you can tell participants you're going to share the actual value of the business if and when the business sells. And so it creates another good retention hook in the business here, because a person saying, hey, if I cash in early, if I'm vested and I can cash in early by retiring or leaving, but I can wait until a transaction and have a potentially higher value, it's another great retention hook with the business here. All right, continue on here. Okay, so pushing on a little bit here, where we're going to move away from, I don't want to share stock, and I want to provide a benefit that's tied to just increased profits. And so we've kind of got away now from the company being the metric of the plan, and the value of the business is not the metric of these plans. And that's often the case if you have a business where there's no plans to sell the business, a family business that you plan on continuing on for a long period of time. And so you don't want really people focused on the value of the business per se, because there's probably most likely not going to be a transaction event. And so this is the first version of something different than a phantom plan. And that is what we call a profit pool, where we tie the value or the contribution a person gets to an increase in profits. Okay. And so what is it? It's a right again. So it's another promise to pay. Any long-term plan where we're promising payment out in the future is going to be a contractual right. And in this case, for them to participate in the accumulation of this profit pool. Usually how it's designed is a percentage of the profits are credited to a pool and then distributed to the participants out in the future. So often designed where you might say, hey, we're not going to share any profits up to this level. So if we imagine we had a budget or goal for the year of $1 million of profit, we might say the first $500,000 of profits, we're not sharing anything into the pool. And then from $500,000 to $1 million, let's say we're going to share 20% of those profits. And so if we hit $1 million, we share 20% of the second 500 or $100,000 into the profit pool. You often might have that crediting rate go higher as you go above your budgeted number. So you might even say something like, and we'll share 25% of the profits above $1 million. Whatever your formula that you use, it goes into a pool, and then each participant is allocated a percentage of the pool. Okay, and so that is done discretionarily. Usually you can make it all the same. I think it depends what kind of number of people you have in the plan. Doesn't have to be allocated all the same. It's probably one of the drawbacks to this type of design is that you do have to allocate percentages to people. And in theory, if you're adding people to the pool over time, you're going to dilute people that are in the pool. So that part of it probably is a little bit of a detriment, but it's a great way to just tie people usually to the increases in profit. As I kind of described that threshold where we don't share profits up to a certain level, often that number is last year's profits or something along those lines. And then you have distributions that come from this. So these are typically in the 3-year range. You've seen them a little longer, sometimes maybe 4 years, but typically you say we're going to have a profit pool for 2025. So we're in that performance year at the end. We credit the pool, we let it sit there for 3 years, and then we start distributions. That person's share in the pool, in theory, is unvested, meaning if they leave the business, they're going to forfeit the rest of the money that's in their pool. If they stay with the business starting in year 3 or whatever year you decide, they'll get annual payments from that pool going forward. So let's talk a little bit about the fifth type here, which is I don't want to share stock here, but I want to provide a benefits that based on the achievement of predetermined performance or financial objectives. So these are called performance unit plans, or short, been called PUP plans for a long time. Used to be a lot more common than you see them today. So you don't see too many PUPs anymore. They actually are a little bit similar when you get to understand them to kind of a full value phantom share, if you will, but they're not tied to the value of the business. Okay, so you're given awards up front to people. So you usually award these, they have a current value, they have a current unit value, and that unit value can be based on all kinds of financial metrics. They were very commonly used when you wanted to just unitize the value of a division or a department, or just put a financial value on it. Very common there. And so again, units were typically redeemable here in about that same time frame as a profit pool. So in that 3-year time frame is very common. Payments are made in cash at the end of the period, and the value of that pup at redemption is dependent upon usually the improvement in somewhere between 2 and 4 financial metrics, right? And so you can have any kind of metric. Doesn't really have to be a financial metric, but almost most of the time I would say it is. And then you start a new cycle each year. So you give me some pups at the beginning of this year, and we're going to measure it. And 3 years later, you're going to give me a payment. Start of next year, you do it again. And so really, once we get out there to the payment point, in this example, 3 years, then I'm going to potentially have pups maturing, if you will, every year, and payments coming every year, assuming we had improvement in those performance metrics. Same concept as the profit pool. Participant must still be employed with the company to receive payouts. So in essence, kind of an unvested plan. You stay for the periods, you get payment. If you leave, you forfeit any value that are in the pups prior to the 3-year point. Okay, last one, strategic deferred compensation. So again, I'm not wanting to share stock, but I want to provide a benefit that offers participants some control, and it's tied to the achievement of some defined performance standards. So strategic deferred compensation is one of the longest versions, let's say, of a long-term incentive plan. So a longer version here. Employees earn contributions into their non-qualified retirement account. So you see it says retirement there because these are typically spread out longer. Now there will be some vesting here, but you would usually set some goals for the year. So similar to the previous two here, some financial goals, and you would say to that person, hey, you can earn, sometimes tied to a percentage of salary, you can earn 25% of your salary if X and Y happens this year. So usually contributions based on preset performance standards. Participants can also add to their non-qualified retirement account here with voluntary deferrals. So if they want to defer more than they can into the 401k plan, as an example here, you can have plans where they can defer their own dollars into these accounts as well. And one of the reasons for that is that these accounts usually are set up as self-directed. So just like your 401k, that they can pre-select a group of usually mutual funds that they can self-direct. And so it's another source of saving for retirement. So longer term, bigger contributions, potentially both from the company and the participant. And these are discretionary. You can put in whoever you want. You can be discriminatory on who's in, so you don't have to include everybody in the organization, just the folks that you want in. And so any vested account value, so you'd have vesting on employee contributions. Obviously, anything the employee put in would always be vested. So those are the 6 alternatives. Again, I kind of broke it down into the top 3 and the bottom 3, with the top 3 being company value based, the bottom 3 being specific financial metric based. And you can kind of see here in the chart what the value is tied to. So a share price or value of the business, and then the bottom 3, usually some key metric there. Can they be total value or appreciation only? You can see here that the top 2, obviously phantom stock options, is just appreciation. Full value phantom stock is total. And then the other 4 can be either of those. You can see whether are these things awarded or are they earned. And you see most commonly phantom stock is awarded. Performance phantom stock obviously is earned, and the bottom 3 are also earned there. You look at typical redemption periods, you see a lot bigger range at the top. So phantom stock often tied, instead of to a date, often tied to retirement, or often tied to a company sale or things like that. So you can have typically longer periods there than you would see in some of the cash plans at the bottom down there, where you might just have that 3-year look, or the strategic deferred comp, a real long version out to retirement. Who can participate? So is it executives, or a little more broad based? I think with all the phantom stock options, you typically are seeing, executive based, right? In public companies today, you're seeing director level and above participating in their equity plans. Private companies, that might be raised slightly, maybe VP level and up. In some of the profit pool pups and strategic deferred comp, or not strategic, excuse me, profit pool and pup, you see broad, you can see much broader. So manager level, potentially even with strategic deferred comp being executive level. I think the key with all of these, and you'll hear that, I think probably as a theme today, is communicating all of this and tying it back so that people understand the plan. Give them context, right? I think if you can get people to understand these things, here is our future, here's how we're going to get there, here's the role we picture for you in helping us get there, and help encourage people to grow and contribute and show them your philosophy about pay and rewards. Here are our specific pay programs, and here's how our pay programs work for you. I think if you can get this across and get people to understand it, you'll really get people that turn into growth partners for your business and feel like growth partners in your business because they're getting to share in the success. Here's a way to do that. And a lot of companies out there use compensation statements, usually 1 year and 1 year in arrears, if you will, is most common, right? So this instead is a look forward and get an employee who might participate in different comp programs, a look at what it could mean over a period of time. So this is a 5-year look here, and it says, hey, here's what we kind of have budgeted for you if we can hit 100% of our targeted results. And so we've got your salary currently at 160, but we have baked in some increases for you here. We have your short-term value sharing plan, so your bonus plan, your annual or quarterly bonus plan. Here's the targets if we hit 100%. Here's your long-term value sharing, so whichever of those 6 it might be there. Here's what some end-of-year values might look like in that plan. If you're contributing to your 401k plan, here's how that could grow. And so then you can say, here's what your total cash looks like. That's salary and short-term value sharing. Here's what your wealth accrual looks like. That's your 401k and your long-term value sharing. And then kind of combine a total look at that across the bottom. And so you can see in this example, a person making, it's not just a $160,000 a year job. It's a potentially $1.7-1.8 million opportunity over the next 5 years if you can help us achieve our targeted results. So it's a way to get people and tie them to your future. So how do you manage comp in an uncertain economic environment? I think we're probably all in that. I think what we found is, during COVID, we had some unbalanced pay offerings. We were heavily weighted to guarantees, salaries, and benefits, mostly short-term, right? We had bonus plans, not a ton of LTIPs, and that pointed that out here. And here you have flexibility, right? When you have both short and long-term, you can vary and you can share some of that amongst and spread it out amongst the opportunities there. And a tool that we have that we use, and this is a first view of what we often see here. And in the pie chart over here to the left is a look when somebody says, here's what I'm doing right now. Typically, this might be for your leadership group as an example. And we plug it in and we see where they're spending their comp dollars. And you can see here it's 75% almost in salary, a little bit of short-term incentive, no long-term incentive, some benefits, a little bit of executive benefits, and your qualified retirement plan. We typically see that, and you see that it's very short-term based, 81% short-term comp, only 6% or so the 401k plan in long-term comp. And so kind of a more recommended version of that is what you'd see over here, where we try to get it a little more long-term, a little less fixed, so you have a little more variable comp in here to give people greater upside and to protect the company in potential downturns in business because we're controlling our fixed comp costs. So those are our 6 alternatives to sharing stock: phantom stock, performance phantom stock options, the profit pool, the PUP, and strategic deferred comp. So I think we launched some poll questions for you all there. We'd appreciate you completing those if you get a chance. And I'm now available for any questions.
Hey, Craig, so we have some questions in the Q&A.
Okay.
First, let's go with one from Jeff Groves. He says, what do you recommend for phantom stock cashing out? 3 years, 5 years, etc. And how do we best gauge this?
Mm-hmm. Yeah, that's a great question. I think I probably tend to lean to a little bit longer, right? I think you certainly can do the 3 years. That would always be the minimum there. I like if we're using appreciation shares to give them a little more time to stew, if you will, right? And a little more time to grow in that period of time. So with appreciation shares, I'd probably lean more to a 4 or 5 year time frame on redemptions. Some full value shares, if you're using those, sometimes you might even let those stew almost out to retirement or something along those, and may not schedule an actual redemption. But I think all of those would depend upon what our plans are for an exit. If we're targeting an exit and we're saying, hey, in the next 5 years or in the next 6 years or 7 years, we're targeting an exit, that's going to affect when we might cash them in versus the family owned company that's never exiting. And we know we have to trigger some payments in here to get people value.
Great. Next question is from Peter Shaw. What type of plan is a virtual equity plan slash long-term incentive plan? Is it the same as a phantom stock plan?
It is. Yep. That's referencing the same thing. I think we found over time, I always use the term phantom because it's kind of the generally accepted term in my marketplace. However, there's many people that don't like that. And so we've come up with things like virtual equity and synthetic equity and equity appreciation plans and other names for it. So you don't have to call it phantom stock. You don't have to use that term at all. But virtual would be the same thing, right? All we're trying to differentiate here is that we're not diluting actual equity or your cap table.
Okay, next question from Anonymous. Is one type of plan preferred over another based on goals of attraction, retention, and reward?
Mm-hmm. So I would say that some version of a phantom stock plan I feel probably works the best. And the main reason for that comes from both sides of the equation, right? I think it creates great alignment with your shareholders because everybody's on the same path here. Let's increase the enterprise value of the business and we're all going to benefit from that. So you get great alignment with a phantom plan. You get it from the participant side as well, right? Because if you're trying to attract great talent, that talent's being recruited by public companies, and public companies offer equity. That's what they offer. And so this is really the answer to that. And so I think if you're, again, a growing business, that it would be probably that phantom equity. Perhaps if you're an older, mature business that is family business and doesn't have, again, ideas of a transaction anytime soon, some of those cash plans might fit a little bit better.
Next question is what is an LTIP in the context of these 6 options?
Mm-hmm. So an LTIP would be the broad umbrella over the top of all 6 of these. And basically in comp here, we put things in short-term comp, which means 1 year or less, long-term comp, 1 year or more. And most of the time, at least 3 years from a contribution and accumulation standpoint. So that's really the sole difference in that term. They're all long-term incentive plans, so they fall under that umbrella. It just means longer than a year, but often 3+ years at least.
Okay, next question is what types and size of companies are offering LTIPs today?
That's a great question. I'll give away my age here, but I've been doing this for 25+ years now. And when I started doing it, and I'd ask somebody if they've ever heard of phantom stock, and 90% of the people would say no. That's changed dramatically. And the size of companies doing it has changed dramatically. I think we saw our clientele being a lot of larger size companies. So I'll call it 50 million of revenue and up. We're doing LTIPs today. We build plenty of LTIPs for companies less than $10 million of revenue. So I'm not sure it's as much a size. It's more of the growth trajectory. Are we trying to grow? And so I think all sizes of businesses can benefit from long-term incentive plan. It's a great planning tool. It allows your business has short and long-term goals. And so you ought to have comp plans that back those up regardless of your size. And so, I would say really anything in that 5 to 10 million of revenue range is doing LTIPs today. And one of the reasons is because the talent out in the marketplace is demanding it. Yeah, I'm sure you guys are in your interview process or in using your placement companies or your headhunters. They're almost all now, when you're recruiting C-level positions, VP level positions, those people understand that LTIPs are a real part of most of their comp packages.
So I have a follow-up question from Anuj Bhargava. He wants to know which plan is the best to do when I don't know the long term. Sell the company versus keep the company.
Mm-hmm. I would say, because selling the company is in the equation there, that I would use a phantom equity plan there. And I would in the design of that, you probably need to think of some other potential payout redemption events other than just a sale. So you can still have all the events covered, right? So you can build a plan that pays out at a sale. You can have a plan that builds out at, redeems shares at year 5 and a sale. And so if a sale happened before the redemption date, well, they get paid per the terms of the sale. So you can have multiple redemption events in there. And so I think that might help your situation of being able to say, hey, we might not sell the business. You still can monetize your phantom stock in that period of time. But if we do, I think we want our people focused on driving the highest value of the business. And the way you get people to focus on that is letting them share in some of that value.
Okay, and it looks like our last question is, who is typically eligible for a long-term plan?
Mm-hmm. Yep. Kind of, I think, a little bit of follow up on what I just said around kind of that VP level and up. Okay. And again, I know this is going to depend a lot on the size of your business and how your org chart looks. Certainly, all of your C suite positions would almost always be involved in this. That's probably the simplest, straightforward answer. To the extent you're a larger organization and have a significant level of VPs, they're going to often be involved in this as well. It can go down to the director level, again, based on size of business. But I think if I had to generally answer it, I'd say VP level and up are typically eligible.
Great. Any other questions from the crowd? We have about 3 minutes left. And if not, I do want to encourage you to take the poll questions. Those are accessed by the 3 bars in your menu, vertical menu bar. All right. I guess we have no other comments or questions. Craig, do you want to wrap it up?
Yeah, I appreciate everybody coming in. I hope you gathered that you have a lot of options with long-term incentive plans. You have options to not granting equity. Again, as I said at the beginning, don't exclude equity. There are complexities to it, and there are tax issues with it that oftentimes make a long-term incentive plan a little bit easier to manage and deal with. But there are plenty of options out there that can fit your organization, and understand you have long-term goals, and so have a plan that supports those long-term goals. And if you create that value, then share some of that value with those who helped create it.
Craig, we had one last question come in, and it also from Manish. We may have a plan to split the company in 1 to 2 years. If so, is it wise to start an LTIP?
It's not difficult to deal with it in either any of the 6 plan types, right? So we can change it. If you know that's going to happen in a year and you don't want to go through the hassle of that, then you might wait if it's only a year. If again, dealing with your situation of having participants that you want to retain and you want to reward, it's not hard to have a plan and then split it when you're down the road. A little more obviously complex than not doing that at all.
All right. Thank you so much, Craig.
You bet. It was a pleasure. Thanks, Linda.
Bye, everyone.
Bye-bye. Bye-bye.